Hello, who's on the call? Who do I have on the call? Hello, who's on the call? Presenters, if you can hear me, you can't come in on the viewing link. You need to log into Google Hangouts or Google Plus and click on my invitation to join as a presenter. If you just come in as a viewer, all you're doing is viewing the call. You're not actually involved. You can't talk, and we can't see you. That's fine, Ed. I know Alan is missing the call. He's in meetings. Tom is trying to get in, but I don't think Tom is. I think Tom may be logged in as a viewer and not as a presenter. You need to log in to Google so that you get my invitation. If there's anyone else that wants to present and wants to be involved in the presenting, we can only have 10 presenters. We can have hundreds of viewers. We can only have 10 presenters. If you want to be involved in presenting, please send me the email address that's associated with your Google account so that I can send you an invitation as a presenter. Here's my email. You can send that to. So. Right now I have a group of 8 traders that I'm sending invites to. So far Ed is in on the call, but he is on another call, so he's just, his microphone is muted. We don't have anybody else on the call. I know Alan wanted to be on the call, but he got pulled into a meeting. I've invited, let's see, I've invited Tom.
Hey, I'm here.
Okay. Who do we have?
Ed.
Oh, Ed, you're off your call. Cool, you're back. Yep. Okay. I'm just trying to help some people get on. I think some people are still trying to understand how the Google Hangout works.
I get confused every time I do it.
Yeah, it's a little confusing. I mean, basically the way it works is there's a viewer link which is just a public link that anyone can come and view. We could have hundreds of people that just want to come and watch. But
the other thing is I'm getting a big echo. I'm like, when I said hey, I just heard that again coming across my speaker. So there's a lot of feedback and it's like a minute delayed.
Okay. When I speak, are you hearing an echo?
I hear you fine, but it's kind of like there's an AM radio in the background, and I can tell that that's what you said a minute ago or what I said a minute ago.
There's Tom.
Hey, I made it. Whoa.
All right. Hey, Tom, let me ask you something. Were you in as a viewer originally?
Yeah, I think I just started clicking stuff, and the view window opened up, and I said, "Oh, isn't that clever?" And then I realized that I wasn't there. I was just on the outside looking in.
Yeah, so that's what I was just telling Ed. I was just telling Ed that the way Google Hangout works is we can have up to 10 presenters because presenting involves audio and video and all that kind of thing, and that's just the limitation of Google Plus. But we can have. I'm actually recording these broadcasts and then publishing them live, and that's the link that's in the calendar invite that goes out to everybody, because that list is like 30 or 40 people. Whoever shows up, shows up. They just want to view and hear what we have to say. But I only have about 8 or 10 people that have have requested or are interested in actually chatting and talking. So unless you guys have a problem with people watching us, it doesn't bother me.
Oh man, I'm just super paranoid, but I'll get over it.
It sounds like it. Yeah, you seem pretty transparent with all your sharing, all you've offered to the group for sure. So why don't we? Well, I'll go ahead and start with what I did today. I've been working earnings plays all week, so I've been kind of light on my SPX trades and whatnot. Plus, I've had some other business things going on, so I've been kind of back and forth. But anyway, let me see here. Are you guys? I'm going to screen share the sheet just so as I'm talking. There you go. You can see that, right?
Yes.
That's our ThinkTank sheet. That's on my sheet. So basically, what I did today are those trades there on. I just basically covered my 3 puts. I went in there and realized, well, they're at 50% or just over 50%, and if I want to even though I had the gumption to want to just stick on them longer, I'm trying to stay with the 50% profit rule. So I went ahead and covered them. So right now, my only open option is that 2005 call, which I think is right now is $2.95. So yeah, so that's where I'm at. I haven't been doing much here because I've been killing it on earnings, though. I don't know about you guys if you do earnings trades or not, but I mean Netflix, I killed it on Microsoft and Apple today, and now I've got a big position on Facebook tonight. So let's hope that streak continues. How about you, Tom?
Well, I've been learning about mitigating risk, and so all of I'm playing some earning stuff too, but that's kind of on on the sideline. Earnings are a little tricky because I don't know, you never know which way things are going and all this other stuff. But anyway, they're fun too. So but in looking at the markets at all-time highs and everything, and Ed brought up a couple weeks ago about the big swings that you see in Karen-style trading, and so I've been looking at that and trying to figure out where do you draw the line, how much risk is too much, and how much are you comfortable with, and just how big are these swings that you go through, and should we consider that normal, or am I not paying enough attention to order entry? And that's the other thing. I'm looking at swing highs and swing lows and trying to figure a good time frame to we're reaching new highs almost every week. So if you keep putting on new positions, new calls, eventually you get pretty lopsided, and you take even bigger swings. So anyway, that's what I've been doing.
Yeah, I totally agree with you. In fact, to be honest with you, the reason that I didn't reload today on SPX is because something in my gut is telling me, and I know I could hedge, I know I could do that, but I just stayed out of it for today because I'm still in that stage where I'm trying to evaluate. If you look at the realized P&L that I've collected over just, let's see, I've been doing this for about a month and a half, and I haven't been super aggressive or anything because I've just been trying to feel it out. But what I've actually collected versus what I've risked is very questionable to me. And so I've been questioning whether or not to even to just take all my SPX off the table, maybe switch to SPY, or whether to even do this style strategy at all. So that's where I'm at. That's why I didn't reload today.
Yeah, it seems like SPX is a big boy, okay, and things can move and you can get in trouble pretty quick. Last week, Thursday and Friday, in my SPI positions, I had a profit loss for the day. Thursday down $900, Friday up $900, roughly. Okay. In my SPX portfolio, it was about 7,000 both days. Okay, and those are relatively big moves. I mean, you kind of sit there and you look at it and you say, "Huh, isn't that interesting?" But when it goes down, you sell puts and your delta gets all screwed up, and when it goes up, you sell calls, and your delta gets all screwed up. And if it continues to go up, your delta is screwed. But you can't, P&L day is just a marker of volatility, I guess. And if your position is staying out of the money, then eventually you'll win, and it'll all come back. Okay, so the caveat, and Sosnoff hit this on the head yesterday, early in the morning. I forget which segment it was, but they were talking about selling puts as an asset class and collecting premium and all of this. And what happened is you see, well, I'm not collecting very much theta, so I'll sell a couple more. And pretty soon you're over allocated.
Yeah, exactly. That's what I don't want to do.
Exactly. So I'm sitting here looking at my position. And I say, you know what? I've fallen into that trap. I wrote that yesterday on my little notes, daily note. And I said, man, I gotta shrink down a little bit here, because I was saying, oh man, look at this. I can collect all this theta. Isn't that wonderful? Till it bites you in the butt,
Right. Yeah, I put a marker on my risk at my margin risk at 60K, and so and that's why when you look at my trades, I'm not very active. I can't do that much, because it's SPX, and so, but I will not exceed my risk over 60. I just will sell enough to stay just below 60 max. I think at one point I was like at 42 just before I sold these. So, just in that range. But yeah, but you're right. I remember I saw that episode with Tom when he mentioned about how, when you've got such low volatility and you're not getting a lot of premium, it's very easy to just say, well, I'll just sell another one. I'll just add another one on, because you want to collect more. But then, yeah, you definitely can over allocate yourself, and then it can bite you. And I definitely don't want to go there.
Well, the other side of that is I've been playing with this theta vega ratio.
Uh-huh.
And so you go shorter days to expiration, and put a position on saying, well, it'll expire worthless in 9 days or whatever. But if you start looking at this on the Analyze tab, all of a sudden things kind of take on a different complexion, and you say,
right. Yeah, and looking at my sheet, it looks super boring and it's super mechanical, but I'm forcing myself to stay very mechanical. I mean, there are times, like, to be honest, I've noticed that you're a little more like, you'll kind of, I'm trying to force myself to stay in a pattern and stay very mechanical, where I won't even look outside of those parameters. Whether that's good or bad, I don't know. I kind of feel like it's a litmus. I'm doing it as a litmus test, though, to see if to do something so mechanical, does it actually work? And that's why I didn't reload today. Normally I should have reloaded, but I didn't, because for $1,600, almost $1,700, that I've actually realized from June 5th, when I put my first trade on, to July 21st, and that's still to find out what happens with the call, and then to think that I made 1670 and I had $60,000 in risk at any given point. I just don't see it. I don't see. I mean, I'm not seeing the number. I'm not seeing the big profit. If I was selling these for like $4 and $5 and $6 and $7, that'd be a lot different than buying them back at 50%. But I'm selling them. They're down to the last 3 puts were down in the 235, 260 range. And buying them back for $1. So.
Yeah, that's kind of where volatility is right now. It's just not there.
Yeah.
So my interpretation of the mechanical side of that is to actually go further out and accept less premium, with the idea that you're further away, so you've got more of a cushion. Okay, so on the call side, Karen says go to 10% in the month. Yeah. Okay, well, if you look and you say, what kind of swings are we seeing and what's going on? If you go to like a weekly chart or something and say, let's draw a trend line and see if we can make a guess as to where we're going to end up in 50 days, okay, at the current trend, let's take a look at that and say, what's the expected move? Let's look at 2 standard deviations, maybe, because at low volatility, the expected move is not as reliable as it is in higher volatility.
Right.
Okay, so you end up getting further out, and then you kind of wonder, well, is it worth $1 to put a trade on?
Right. Yeah.
But what I'm seeing, especially in this low volatility, the difference between having portfolio margin and regular margin, and having a reasonable amount of money and not very much money, makes a huge difference.
Absolutely. Yeah. I mean, if I've got $10 million, that's obviously, I get the exponential growth of the P&L, of the profit, and I get that. I think what it comes down to is it's relational, right? It's relational. How much risk are you putting on to make money? I mean, an insurance company would be doing the same thing. How much risk are they putting out based on the premiums they're collecting? And so that's kind of what I'm acting like. I'm looking like this. I promised myself I'd do this for 2 months, and then I would evaluate it and look at, okay, when you stayed with an exact system and you did it like I didn't want to deviate. I mean, if I'm deviating, then I'm just doing regular options trading. I mean, I do that in other accounts, and I do that with other trades all the time. I'm trying to trade SPX exactly in a system, basically based off of what Karen states in her interview. I'm not trying to say, well, maybe this one I can do a little this way, that one I can do a little this way. No, what I'm trying to do is stay exactly at 10% of the money with the calls, the same ratio and whatnot. And maybe I'm being too regimented, but I'm doing that for a couple months because I want to see what was my risk at the time and what was my profit, and how does that compare? Is that something that I could turn into just an automatic system that I would do all the time, that I'd be willing to risk, or is it really not worth it? And so that's kind of where I'm at, because I'm coming up on my 2-month, I'm coming up on my 2-month anniversary here, and so I'm really starting to think about, well, okay, I made 1,600. That's great. I mean, don't get me wrong, that's good, but I had a lot at risk. I had, quite a bit at risk to do that. So that's kind of my thoughts on it.
Yeah, well, I have a trading partner that is more regimented like you, and less free flowing like me. Okay,
right.
we make a good couple, if you will.
Right.
But anyway, there's the answer is somewhere in between. Okay, if you kind of follow what Karen's saying, she says she just kind of takes what the market throws at her and works with it. Okay. I don't know what she's doing right now, but in 2013, volatility dropped, so she says, we didn't make very much money. Okay, 20% or something.
Right.
All right. Now, I have 2 accounts that I'm doing this. The primary one is with the SPY, and it's a normal margin account, and I'm trying to stay pretty true, although I deviate here and there a little bit, but for the most part I'm paying reasonable attention to what the Karen strategy as I perceive it is. Okay.
Right.
And so and that account, it's $200,000 account, and it's up $11,000. Okay, and I started that January 1st. Okay.
And how much of that how far leveraged were you on that account? I mean, how much risk would you allow yourself to have?
Well, I just cut back.
Analyzed tab.
Yeah, I just cut back. I was 80% invested.
Okay.
Okay. And now I'm about 60%, which is still a little too much. Okay.
Right.
So I need to cut that back. But anyway, so that's kind of where I'm going right now.
Right.
In March, I decided to look at a SPX account. Started with $400,000. Okay, with portfolio margin. And what I wanted to do was compare portfolio margin with regular margin to see how that worked, and I wanted to learn about portfolio margin. Okay, that account's up $100,000.
And that's paper money.
Since March, yes.
Yeah. And were you real aggressive with that as far as like deviating, or are you saying you traded only SPX?
I traded only SPX, and I was actually rather conservative with that because it was a learning process, and I had a big blowout, and one day I lost, what, $12,000 or something in the account, and I was all upset and trying to figure out a way to trade around it and all this other stuff, you know. You know, there's been some wild swings in that, but I'm surprised. I don't really pay attention to, you know, how much you're making. I'm just trying to go through the mechanics, and I'm looking at the Analyze tab and trying to understand, you know, the risk and how big a move, and if volatility goes up 5%, can volatility actually go up 5%? I don't think it can in this market, can it?
Yeah, right. It seems like it goes up and then right back down, and then goes up.
Yeah,
and then
volatility
back down.
only goes down or stays the same. You know, there's people standing there with big hammers, whatever. As soon as it pops up, they beat it back down.
Yeah, definitely.
But anyway, it's been a very interesting, because this has been since March. We haven't really had volatility, okay, and the deviation from Karen trading with the SPX account has been in, I guess, scalping the last few days, you know, the last week of expiration. I'll say, well, look, there's some premium in these puts or calls or whatever, and then I'll look on the Analyze tab, and if there are 2 standard deviations plus the probability of touch away, I feel reasonably safe in just taking the trade.
Selling the junk. Like 1 day, 2 days out?
It's like 7 days,
Okay.
the week up.
The week up.
Okay, 2 days there isn't anything left. You know, I mean, it's pretty much right there. But usually the Friday I take a look at it and say, okay, what's expiring next week, and is there any premium? Can I do anything with it? And you know, I call it kind of scalping because, well, you know.
How much can you get on a contract typically on average?
No, geez, not very much.
Like
but
less than $1, I would imagine, like 50 cents or something. Or?
Well, let's see. So on the August ones,
yeah.
Yeah, 60, 70 cents, 80 cents.
Yeah. So you're talking about like 4%, 4 or 5% ITM probability.
Right.
Yeah.
Yeah, I'm looking for trades around $1, okay, but don't always get them, and I don't always take them. Quite often, I'll just say, well, that doesn't make any sense, and you know, and some of this is based on, you know, talk to Slim and his cycle charts. Are we in an up cycle or down cycle? You know, what's the best market awareness that I have based on charts? Okay, and from there, can we actually speculate what's going out? What's the expected move? You know, what's this? What's that? And I, you know, go through this question list of everything, trying to understand, you know, what's going to happen, and then based on, you know, just general market conditions or what have you, I will come back and either take the trade or not, and it depends on how much I have at risk and where my Analyze tab is, you know, telling me.
Tom, that's not a Karen trade. You know, you're scalping. That's not a Karen trade, right?
Yeah, that's
Karen flows to the market
Yeah, but there, no. Ryan said, he's trying to follow the rules, and he's being a rule guy, and you're saying you're a little bit of a cowboy. I'm a cowboy too, but if I'm scalping, that's not Karen.
Right.
So I wouldn't even put that. Yeah, it could be SPX, but I wouldn't even put that I would not put that on my spreadsheet of Karen trades if I'm scalping.
Yeah, yeah.
Well, I'm
That was
selling.
that was kind of my point. If you look at my spreadsheet, I mean, I'm doing other trades and stuff, but I am not. I am only putting. I'm trying to look at this as an experiment, as in terms of, all right, if we follow all the known information, I'm looking at it right now. I'm looking at the 1750 September 14th, 1750 put. I can get $2.60 for that. I'd probably get a little more, but it's just, and that falls right in the rules, Karen rules. 57 days out, 5% probability of in the money, but it's $2.60. So my whole proposition on this whole thing is, right now, do I just sit on my hands? Is the risk worth what I'm getting in return? I'm out there buying this or selling this SPX, putting risk out there for what could end up to be $1.20. So
Guys, I took one off today for I think I got 320 for it. I took it off for $1.50 yesterday, and I took one off that was a fat-fingered mistake that I had to buy insurance on a few weeks ago. I had to put it on for insurance because SPX was hitting new highs, and my calls were going against me, and I didn't have a put side on for that trade, and I took it off today for $1. So my attitude is, when I do a presentation about this, I tell people, you're not going to get rich here. This is a 5 to 7, 8, maybe if you're lucky, 10% a month. That's what that's all this is.
right.
Based on, and I say it's based on your margin or your, buying power effect or whatever. I mean, this is not, this not get rich. And I've been doing, like I say, I've been doing this with 2 contracts for the first 2 or 3 months, and now I'm up to 5 contracts about every 2 weeks. I'm putting on a new trade for 5 contracts, and
Right.
one of them was just like you said, Ron, $2.60. I think I got $2.75, and I was lucky to get that because it was dropping.
Right.
Yeah, I got my $1.30 out of that or whatever, and I'm off.
Yeah, and for me, my mission, I'm trying to research this and find a strategy. Find something that's repeatable. I could just do different trades and make adjustments and do that kind of thing. But I mean, that would just be regular options trading. I think the whole speculation, this whole thing, at least for me, was with with what we call Karen style trading, was to try to figure out, is this a legit strategy where if you actually follow this exact pattern, these exact steps, will it consistently generate profit for the risk that you're putting on?
Okay, so my question for you is, what is that number? Ryan, what is that number?
Right.
Do you know what the number is? Because I know what my number is. I'm happy with that 7 to 10% a month.
Exactly.
What? It's okay. I'm happy with that. And to go along with what Tom was saying, I'm so happy with it that in my regular IRA margin account, I am now putting on trades with that. And what I'm doing is I'm only getting like the last one, the first one I put on was $1.10. I'm taking it off at 50 cents. You say, well, Ed, that's not a lot of money. It's 50 cents in 2 weeks. How many contracts can I trade in IRA?
But I think there's another question to that, though, Ed, because we haven't had it happen. So I think there's more than just, are you happy with 7 or 10%? I think, of course, anybody would say I'm happy with somebody just paying me 7 to 10% a month. However, the big elephant in the room is 7 to 10%, and how much risk do you have at stake?
Yep.
and that of course goes back to the what if scenario. Is it worth it? If I go to Vegas and I have, $50,000, I know that I could spend 10 of that and I could walk out of there with the other 40 and never. The case here is that's not the case. I mean, you're putting
I disagree.
Every time you go to the table, you're putting your entire $50,000 at risk to maybe make $100 at the table.
And I don't agree with that. I disagree with that.
Okay. You don't agree that
No, I disagree with what you're saying with regards to the Karen trade. I can put my $60,000, $70,000 at risk, and you're saying, okay, last Thursday, earlier in the week I'm up $1,000. On Thursday I'm down $2,600 to $3,000. I went negative, okay? And I said, well, why is that? You look at the news, it's pretty obvious. Friday, it all came bouncing back. So Tom, that's why I don't sweat those kind of details. But to answer your question, Ryan, is my attitude is my closest short position was 1810. The market got down to what? 1945, 1950?
Right.
Okay, so what happens if it dropped more? I look at that spread I have on as, even though it's pretty wide, so I look at it as being negative. I went and checked my deltas. None of my deltas had gotten up above 5 or 6. I'm saying I have no pain other than giving up profit. If this were to go, what am I doing? I'm rolling out. I'm going to roll out, and I'm not going to lose money. I'm not going to make money, but I'm not at Vegas all or nothing, baby. I'm saying, okay, I got to sit on the sidelines. Okay, I can do that. And that's what gives me the confidence to be able to say, let's say your entry-level portfolio margin is 125. I could put $60,000, $70,000, $80,000 in these trades, because here's the other thing that I'm not doing that I disagree with Tom on. I don't want to scalp these. I want to put these on as close to 56 days and let time do its thing and me take them off 50% to 2 to 3 weeks. And then I'm putting another trade on, so I've got myself that kind of time. So
I agree with you. I agree that that's the strategy. The strategy, it's a theta strategy for sure. I mean, it is not a scalping. I mean, those are all other strategies that are definitely valid and can be done, but this in particular is definitely a theta strategy. However, yes, I agree with your point that it's not where, it's not like you potentially would have some time to do some magic and work your way out of some things and whatnot. But, I'm the type of person that never say never. You don't know what kind of black swan event could occur. And, you're out there holding these contracts. What if you can't buy them back? What if those things start to occur and you are stuck? Don't think for a minute that TD won't liquidate your account, and they own you at the end of the day. They own that money. They're gonna take action, and it's in the agreements that they'll take action if they have to.
Yeah, so, I agree with that.
So my point is, when you are in Vegas and you are at the table, the pit boss has his hand in your pocket. He says, hey, I'll hold your money for you. We'll give you your money as you need it. We'll even give you some more. We'll give you some markers. We'll give you more when you need it. But if there's a fire or if anything happens here in a second, you don't have that money in your pocket, Ed. He has it.
And I'm agreeing with what you're saying, but from what research I can do, talking to the trade desk, talking to the risk people, and talking to the portfolio management desk, I can roll, not close, but roll to a different position. I have to pay whatever it's going for at that time. Right. I agree, but I'm not closing out one thing and reopening. I'm rolling.
Expect the unexpected.
That's why I got that in there.
A lot of what we do is, the charters and looking at historical, that's great and everything, but that doesn't mean that there can't be a first time. I mean, there's always a first time. And so if you're trying to protect your assets, that's my only, I'm looking at this as like I'm an insurance company, okay? I'm selling insurance is what I'm doing. I'm selling insurance to whoever wants to buy these buy these contracts. I'm selling the insurance. Yes, I'm selling it where I have a 95% probability. I love that. I love the idea. Like I think Karen made a statement in one of her things. If I knew that I could play blackjack and win 95% of the time, then I would play every time. However, that 95% of the time, that 5% of the time that you could lose is not just losing what's on the table, but could lose additional funds. That's my only point. And
But that's
we
the
can't
nature of what
forget
we
that.
do. That's the name. So if you, but I'm saying I used to do iron condors that were real wide, and I kept getting my ass. You're right. 10 times out of 12, I made money. It's those next 2 times I gave it all back.
I agree.
Here, I think I've got an adjustment strategy that's going to work for me. Now, you're telling me, Ed, you haven't played it yet. You don't know. Toss might not let you play that way. You're absolutely right. I don't know. I can only ask as many questions as I can ask. The flip side is, I can buy puts. The flip side is I can buy futures if it's going down. I can look at the volatility and say, wait a minute, we just went from 11 and now we're 17. I better have my ass in motion. I'm not sitting with my head in the sand though. But the flip side is don't trade it. And I don't have anything else that works as consistently as this. Every trade I put on has been I've taken off by reaching my profit goals. Sometimes my profit goals were 50%. In the early days, I was trying to take it off so that my short came off at a nickel. I don't do that anymore. I graduated up to 25 cents. I don't do that anymore. I say whatever I get, I'm off at 50%, and I try to make that 2 weeks. You get a couple days like last week, and it throws you 3 days in advance. I can live with that.
And my view is I'm trying to look at, just like an insurance company would look, what's the premium? Is the premium worth the risk that we have in place? That's the question that I'm running through my head. Like I said, if I were getting $6-7 for these contracts, then that would be different. But if I'm getting $2.60, $3, $2.50, is it worth the risk? I think that's the number one question you have to ask. I mean, yes, I understand hedging and I understand, being prepared and all those other things. But to me, the core question is, it's just like anything. If I'm going to go work somewhere, what is the value that I'm getting in return based on my risk, or in that case, based on my time? If I'm only collecting, a few dollars for the amount of risk that I'm putting on, then as much as I love that it's automatic and it keeps coming and it works and it hasn't been broken yet, as much as I love that idea, that could all go down so fast, so quick. Just like an insurance company, if there's they're covering a building and there was a huge earthquake, that could be gone for them. They could be up the creek. So that's just, for me, that's my number one question is the strategy working?
And one of the things I'm doing to address that, and I don't have the answer here, but one of the things I'm doing is, I was listening to John Carter the other day, and he said he can't do this trade. It's too boring for him. He said, but I got a lot of friends who will put on SPX trades. He didn't call them Karen trades. He said SPX trades. They put them on at a 10 delta at about 60 days, and they take them off at 30 days. And I'm saying, well, let me go back and look. And guess what? About 60 days, SPX was trading for about $7.30. I went back 30 days from there, and I could have probably got out for about, I want to say less than, about $2.50 or something like that. So I would have made about $5. You say, well, is $5 worth it for 30 days? I don't like the 30-day feature of that trade. Okay, I'd rather put the trade on at 60 days, take it off at take it off at about 46 to 45, or if I'm close, give up a little bit on my 50%, or if I'm pretty far away, hang on to it for a couple days. I say pretty far away because, example, last Thursday some news happened. I had to stay in those trades longer. I thought I was going to be out Friday. I'm out Tuesday and Wednesday. Okay, it is what it is. But for me, I mean, I'm okay with that because I know that for my 5 contracts, I'm risking something like buying power effect right around 16K, and I understand that that's buying power effect. It's not real money. But I'm saying okay, and I'm going to pull that off, and I'm going to make about $700-800 in about 2 weeks, and I can roll that thing 2 times. Okay, I'm okay with that. And yes, yes, you can say, Ed, it's just like it's you're good until it happens, and then it's not good anymore. I get you, but
Yeah.
I'm saying as long as I think I've got an adjustment strategy from back testing. That's what it seems to have worked. Does that mean that Toss would be able to take my? Who knows? I don't know. If we were getting 160 rockets hitting New York City, in 2 weeks, where would the stock market be? Zero? Maybe. Could I get out? Probably not. Would I lose it all? Maybe. Would I be a panhandler out on the streets of Chicago? Yeah, I guess I would.
Yeah, I mean, I don't think it's something that catastrophic, but when that market starts to drop, 300 points, 400 points, I'm sure that it's going to be very difficult to maneuver around. That's just my gut feeling. I've never been through it. I'm new to trading. I'm not trying to say I'm an expert or anything. I just in my other line of business, it's what I do. I prepare for the unexpected, and so I'm paid to ask those questions and think about the what ifs, even if they've never occurred. So,
you know what? Then I would say to you, please keep doing that, because I'm involved with another group, and I'm meeting with the guy this weekend, and we are kicking the tires this very direction because, except for that feature, this is a little ATM machine. You're going to make
I totally agree
7
with
to
you.
8, 7 to 10% a month. This ATM machine.
That's why I'm so adamant about staying in the system and not because I'm looking for a machine. I'm looking for something. I want something that I can put 5-10 people on and just say, okay, do this. Here's a list of exactly what you need to do. You don't even need to think. You need to do this. That's why I'm testing this whole thing. That's why I'm evaluating this, because I want to stay in the system. I totally agree with you. I'm on board there. I want to create a machine, but I want to make sure that machine doesn't have a time bomb in it that could blow up and just you'd look back and be like, okay, well, what did we do that for? It's all gone. You know what I'm saying?
So my question for you is, short of that happening, the only way I know to get around it is backtest is one approach, and the other approach is to talk to the people at Toss and say, if this happens, what happens to me in your environment? And right. I got to be honest with you, the answers are, you get answers, they're a little nebulous. You keep peeling the onion back, and you can only get so much, and then it's kind of like you either trade or don't trade is what it comes down to.
No, I mean,
and I agree with you.
My opinion of that is that if something like that was to happen, it's everybody for themselves. I mean, I don't think for a minute that TD is going to, step up and protect their customers.
I don't think they would. We're in agreement there.
Cover themselves.
Yep, we're in 100% agreement there. Everybody for themselves, and it's kind of like, can you get out and save your bacon? And, did you skate underwater? Now, before I forget, I had a conversation with the portfolio management desk, and I learned something new this week that I didn't know before. On Sunday night or over the weekend sometime, I don't know if you guys looked at your portfolio margin accounts, but my trades that I had on, they were 100%. It was 100% margin. They weren't giving me portfolio margin, is what I was trying to say. So I called them up early Monday morning, and they said, well, sometimes we don't get data feeds over the weekend, blah, 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 blah. As soon as the market opens, it'll correct itself. I went into 835, 840. It didn't happen. I called them up, and they said, yeah, we know there's a glitch. It'll probably separate itself out here within a little bit. You still have portfolio margin. You're not anywhere close to your number. Don't worry about it. I waited half the day. I called back, got to trade desk. They sent me to portfolio margin. The guy said, you've called here a couple times. I said, yes, I have. He said, it's a glitch in the software. It'll be done by the end of the day. I said, okay, so let me ask you this. If I put a trade on and that buying power effect that I get on the confirm send thing, I said, is that the fake number or is that what my account says I would add to my buying power? He said, if you're doing portfolio margin, you don't want to use buying power effect. You want to use margin. You don't want to use that confirm and send box to get your number. You want to use the analyze tab. And when you use what?
Yeah, I learned that too. I talked to him too.
He said when you use the analyze tab, I said, well, okay, let me do this. Let me kind of do this trade with you. You put it on. You're looking at my account. I want to put 20 contracts on. What does that do for me? He says, well, first of all, you would fall into a special category. I'm saying, okay, I'm in a special category. I'm thinking no big deal. I said, what does that mean? He says, well, based on your portfolio margin account, you'd be in a special category. Again, what does that mean? He says, well, you've traded over your portfolio margin account, so you're in a I said, what does that mean? He said, you're allowed to go to your net lick, and if you go over your net lick, you either better be calling us, we might try to call you, or we're going to take steps on your... I said, oh, so it's a margin call. He says, no, but it's kind of like that. So what that told me is that's the value of knowing your net lick. And you say, well, wait a minute, we're trading a lot of contracts in SPX. Well, yeah, you are, but if you got close to your net lick and you had a lot of other positions on, like say, you have X amount of stock on or whatever you call it, you got to make sure that your SPX trade minus all your other positions does not get you close to your net lick. That's the moral of the story. And I didn't know that before. I'm just kind of like, I'm just saying I don't want to be this much or that much. Now I understand that net lick number from a whole different category. And it's like, oh, well, that's interesting. Now I can do this.
Yeah.
I didn't know that before. It's like, I don't know what I don't know until you tell me. You know what I mean?
Yeah, absolutely. I mean, the way I operate on a daily, not even a daily, on a minute basis, and I think probably, Tom, you would concur, because I think you do the same thing. I have my price slices set up in my Analyze tab to drop the market all the way down 20%.
Well, these guys said 12, by the way, was the magic number. If you're
game, exactly. And so I go farther. I go 20%. I mean, Karen actually mentions that. What she does is she actually subtracts 100 or 200 from the current mark, and then she goes down from there.
Well, she goes 12% off the. She goes 12% off the 12% off the current price, and then $100 below that is her program.
Right. And I just do 20.
Actually,
I do 20%.
Does that, Ed, she does that a little differently. I've listened to that, but it comes out about the same. She actually drops the price by 100, and then takes 88% of that. But
so it's kind of interesting. You heard it that way, and me and 3 other guys, gone back and listened, and we heard the 12% and 100 below the 12%. Now you're saying, I'm going to tell you, what are we talking about? $10?
It's about $50, but it's about the same. But I do it the way you're talking about, because it's just so much easier just to have it drop 12%, and then I can just look and drop 100 off that. And then I take a slice at negative 20%, and that's reasonably close to dropping it 200 points down.
Right.
Not the same, but anyway.
But I now know what that net lick means to me. That's your margin call, and I didn't get that before. I never, whatever it is. I mean, I was never close to it, so it never mattered to me. But putting on 20 contracts got me there. You know what I mean?
The other thing you have to keep in mind too is we're just discussing when you're using that Analyze tab, you're just looking at only your SPX weighting. They also, they're taking your whole portfolio into consideration.
And that's what I refer to, your net lick in SPX plus all your other positions. Your SPX, your SPX P&L loss at 12% plus all your other positions cannot exceed your net lick.
Correct.
And it's okay. Now again, it's one more piece of the puzzle. And I said to the guy, I said, hey, look, I know a lot of guys, we're trying to do this. We kind of like to know the rules of the road. His response to me was, I said, I'm in Chicago. Can we come down and, meet with you? He said, no. I said, why? He said, you are a self-directed investor. We're not here to give you investing advice. I said, I don't think I'm asking for investing advice. I'm asking what the rules of the road are, so I understand how the program works.
Yeah.
Didn't want to go there with me. I said, okay, whatever, we're done. Thanks a lot for your help, buddy.
So look
I've had friendlier people that I've actually spent a lot of time chatting about, but basically, if you have a more than one underlying, you beta weight everything to SPX, and the margin call is based on 10% up and 12% down. But they have another one that they look at, which is some multiple of 20% up and 20% down.
Yeah, Tom, can you guys click on my screen? Because that's what I wanted to mention. I had a conversation with him. I thought I shared this on the first call we did. But if you look at my screen, these are my notes from, because I keep everything in a noting application, my notes from that call. But what I've highlighted there, this is what the guy told me on the overall portfolio measurement of your margin. He said they beta weight it against the SPX, and he said if on a down move, if you exceed 2 times your net lick,
right,
20%, and then 20% up 3 times. That's what they give you as far as the spread before they ever start to liquidate anything or sell anything on their and cover.
Right, and then they look at the Greeks. Their algorithm for managing stress or risk, I guess, is based on how the Greeks line up too. So if you've ever been in a world of hurt with a position and had it kind of go against you, all of a sudden you begin to see how gamma and delta work together on a tick-by-tick basis, and it can get real ugly real fast.
Right.
Okay? And that's what I ran into with my SPX account. I went from, what did I have? It was like $130,000 of buying power. All of a sudden I was in the money, had negative delta, and the market was going up. So I had zero buying power, I had negative buying power, and when I finally got out of the position, I was back to $160,000 buying power. And I said, wow, that really slams you up one side and down the other. Okay,
yeah.
So, and the gamma numbers were huge. I don't remember what the gamma numbers were, but they were absolutely huge. One thing I wanted to touch on for both of you, the theta decay of an out-of-the-money option from 60 days out to 30 days out is very similar to the theta decay from 30 days down to about 10 days. Okay?
How far out, Tom? How far out of the money?
Just out of the money. I haven't actually tabulated these numbers. I've been looking at other people's work, and they show the in the money or the at the money graph. It falls off very rapidly the last 30 days or whatever. But once you get out of the money or in the money, it's more linear. And I believe what Karen is doing is she's looking at this 60 days out, 56 days, whatever, down to about 30 days. And when she's in the current month, they're either far enough out of the money to expire worthless, or she's taking her profits and they aren't there anymore. Okay? So if you track this as you go through, you begin to see that when on the put side, when it comes down to 30 days, you basically have no trades left. Okay?
When you say no trades left, you mean what? There's no
in that expiration on the put side.
So you're saying there's no premium left, or there's no reason to be in the trade?
Correct. And one thing that she kind of threw together was the reason she can sleep well at night with the amount of risk that she has on the table is because she has time on her side. So if the market corrects, you know, last week, what, it took one day, it dropped 1% and came back up 1% the next day. Flash crash, how long did it take? You know, a day or two, whatever.
Yeah.
So if you look at this, if you're, you know, we're all looking at a downside. What if it crashes up? Oh my God, you know, then we're in trouble. You know, hey, that's what's happening now. But if it crashes down, you've got and you're mechanical in taking your trades off, you know, at 30 days. You know, when it comes, you know, if you're trading in the range from 60 days down to 30 days, and basically taking them off at 30 days, you've got 30 days to figure out what you're going to do.
Right.
Okay.
So,
now your margin.
So again, my program is put them on at 56 days and take them off 2 weeks. You know, put them on Friday and try to take them off in 2 weeks on Friday. So I'm even less than 30 days. I'm 14.
Well, that's fine. You've got even more time, but you know, the idea is you've got time on your side, and then when you have time, a lot of things can settle out. Okay. And if you go back and review the flash crash and the cancel crash of '87, and you know look at the amount of move and how many days it took to actually have that move, and then the problem is recognizing that it's a crash, okay? Because it's not just gonna, the bottom's not just gonna fall out, okay? It's gonna go down, and people are gonna say, oh, this is a dip. We're gonna buy, you know, have a buying opportunity here, and you'll go in, and then you'll have a little rebound, and then it'll you know, drop back down again, and then pretty soon you're just kind of like a deer in the headlights saying, oh my God, what the hell is happening? Okay.
Yeah.
So,
Thank you, Tom. Thank you. That's what I was talking about last time, where I said, just like last Thursday, I'm up $1,000. By the end of the day, I'm down $3,000. I wished I'd have taken that trade off at 900.
Yeah.
Hey guys, I'm sorry to interrupt. I have to actually go pick up my daughters from school. I had to cut the call short, but I can leave this going if you two want to talk, or it's up to you.
Hey, you know what? That's fair. I need to get out of here too, because I got a couple things to do, and you know, it is, you know, so that's all right with me, Tom. How about you?
I'm good. I think we're, you know, the big thing is to try and cover risk, and
Right.
the important thing is if we have time on our side, okay, and if you're mechanical at taking trades off at 30 days, you know, 50% or whatever. The interesting thing is when Karen talks about taking trades off at 20, 30, 40, and even 50%, I'm not sure what she's doing. The other thing that I'd point out just in closing is that we don't know what all Karen does. Okay?
Amen.
She said her generic trading, a general statement, is this. Okay? And I went through and followed that, and I said, okay, fine, whatever. So, Ed, you're saying that Karen doesn't do scalping. I'm not sure I'd agree with that.
I think Karen scalps, but on the futures. I don't think it's too hard to get in and out of SPX. Get in the futures if you're going to scalp.
It's easy to get in and out of SPX. Anyway, I don't have any problem with that. So you give up a few points, but you're scalping. I mean, you know, what the heck? And you know, I'm not really scalping. I'm trading in the last week, which is whatever. But I'm buying protection by being almost 3 standard deviations out. Okay. And so I've got a short period of time, 2 standard deviations plus probability of touch, and I'm staying outside of that. If I can get any premium, okay, then I say, well, okay, and I'm experimenting with this theta to vega ratio, trying to keep that in a area that's advantageous. So anyway, so that's kind of what, what the big thing is the risk. If you have a big move, look at the Analyze tab.
Well, that's what we're all working on. If we can figure out that, like I say, I think we got an ATM machine. But there is it is a fact. We got to work on that. Hey, I'm out of here unless you guys got something else to say.
I'm out of here.
Talk to you later.
Bye.